Hey everybody, traders, happy Friday. I guess happy Friday. No, it's fine. Just after 3 o'clock on the 28th, back. They have taken a nice swing at the market. You can kind of sense that was happening yesterday with I guess Wednesday, Thursday. We had the market essentially rip up Monday, pause Tuesday, fall Wednesday, fall Thursday, and fall today. So, yeah, not a great day overall. We'll take a look at the tape. Um, Overall, I mean, the week was fine. It was, I mean, recap wise, here are the trades that I had. 5 for 6 this week on daily profit play. Waterfall income, we close out for 16 winners. Double up had 3 winners this week out of 3 trades. Newsbreakers was 2 for 3 with winners on Chewy and GameStop. Took a loser on PDD. Project Options Edge, we had 1 winner on Gold Futures with the class cut up at 4 p.m. So I got another couple of trades I'm going to be posting there. Other winners had a winner on IWM, Coinbase, Tesla, QQQ had 3 winners. SPY had 3 winners. SPX 1 winner. These are all separate from the services. These are just just in the portfolio. I was doing a lot of defensive trading this week. 1 winner on the DIA for the Dow, winner on TKO, SMH for semiconductors, and AXP for Amex, so ratio spreads. So all in all, 5. Let me just do the math here. So had a lot of winners again this week. Just doing defense, closing out for winners, taking profits, building back cash. Way better positioned for whatever comes next. If we have another flush lower, I feel like I'm properly hedged. I've lowered the overall deltas of my portfolio. A lot of trades are still way out of the money, trading for like the expected move to be probably more so than the actual move. A lot of these trades were taken over the last couple of weeks when premiums were high. So all in all, 5, 16, 3, 2, 1, 1, 1, 1, 3, 3, 1, 1, 1, 1, and 1. So 41 winning trades this week. 1, 2, 1, 2. Yeah, out of 43. 41 winners out of 43 trades. It's not bad. 41 winners out of 43 trades this week. Not bad. So I'll take it. And the journey continues. Just keep trading. I'm just going to be like a Dory. Keep swimming. Keep trading. So way better positioned. When we had a flush, I mean, we were pretty close to the recent lows. Let me go back to this. I'm actually looking at a trade right now on comparing CrowdStrike versus Palo Alto. I've got a couple trades I might be looking at. FTNT, let me take a look at that one as well. I'm looking at the cybersecurity place right now. We've got some decent Snowflake analysis on each one. Earnings forecast to grow. Earnings are growing. Price to earnings, a little cheaper than actually CrowdStrike and Palo Alto, but trading a fair market value, which I don't love. So I don't think I'm going to get the options premium like I want compared to its peers. Palo Alto's at 92.1 price to earnings. I don't see CrowdStrike on here. So I actually like the pricing of CrowdStrike. It's a bit of a longer term trade. I was going to put this in for my project options class, which I'm doing a class at the top of the hour at 4 p.m. So I'll take a look at this one. Let me see here. $55. I don't think I'm going to get what I want. I'm going to place this trade first. So I'm looking out to January of next year. I know that's a long ways out. This is an income trade. It only requires about $1,900 in buying power. I'm willing to own the asset. I would own this at a oh boy, I'll do the math here, like probably 181. So 190 assignment minus 4.28 minus a $5 trap. I'd own it at 180.72. 180.72 on crowd. Off the 460 highs. I mean, that's a pretty favorable discount. Granted, it's not a guarantee. Price obviously might do all sorts of wild and crazy stuff, but 180 would be around a 60% discount. That would be below the lows in August. The overall concern would be, yeah, we break these lows in August and we come all the way back down to these lows after a bear market in 2022. If there is a major de-risking or deleveraging event, then perhaps this is a nasty bear market. But right now the deltas are low. I can get the price that I want. I'm willing to take the shares and repair. So I don't mind the trade. So I think I'm going to take it. It's an income trade. I'm going out a little bit farther. But for the accounts that can take it, I've got about 4 portfolio margin accounts I'm going to place it with. And I'm going to get hopefully like 4. Let me see if I can get like 420 for this trade. I'll try for 425. Try this here. And review and send. So buying power 548, that's not too bad. 425, not filling. 420, not filling. 420, 415, not filling. If I get over $4, I'll take the trade. Let me go 414. I'll just penny this down from the mid price. 413, 412. All right. Hopefully I'm getting filled at least over $4. If I work this down to $4 and I'm not getting filled, I'm not going to take the trade. 410, no go. 409. And usually what happens, I was usually going to say, like, if I don't get this down, I filled at 408. Okay. So that trade's in. This trade here for 408 filled. This trade for 408 filled. Okay. So it is in. I'm going to add this into my tracker. CrowdStrike. We have a 1/16 of 26 expiration. So I'm buying the 200 put. Shoot. So buying the 200 put, selling the 195 put, and selling the 190 put. $4.08 credit. Willing to own. The break would be 190 minus 5 minus 4.08, 180.92. Okay. So that trade is in. I'm going to get that one built out and posted for my Project Options Edge. So this is CRWD. Going out to January. Starting at 2, so I'm buying a put, and then selling and selling. 195, 190. Okay, so this is the trade. So there's risk if price goes beyond 180. We're trading right now. So this is interesting. If you look at a standard deviation here from current price, a standard deviation is just beyond my potential risk zone. So, could this be around like a 167, 168? It's very possible. The IV on CrowdStrike is not super high, so I'm not surprised that my one standard deviation is slightly above the, or my trade is slightly above the standard deviation move. But we'll see how it plays out. Anybody home? RF, I see you. Amazing, I see you. Yeah. Type in the chat. Say hi. Happy Friday. So this is the trade. There it is. So I like the trade. I could probably work it down a little bit lower to take on less risk, but rather than getting $400, I'd probably have to shave that in half. Maybe get $200, maybe get $100, and I'm sure I can move that past the standard deviation. But I think in this space, fair market value on this is reasonable. So if I go back to this for CrowdStrike, so price to earnings 23 times price to sales. Fair value is 400, and I would be owning this thing around 180. So, we could stabilize here. We can go back up. This trade never gets assigned. I just take on the income, and that's okay by me. But, it is a little bit higher price to sales compared to its peers. Palo Alto at 13.5, Fortinet at 12.9. So that is why I was looking at all three of them to maybe play the space a little bit. Just with some option trades. I think that let me check IV on each one. So CrowdStrike, IV's at 34.8, Palo Alto 35.4, and Fortinet is 37.2. So the IV's comparable on each one. The question is, can I find an income trade on each one? And if I can, great. Also, if I had to get the assignment and I went out, 30 days, me go to CrowdStrike here. If I go about 30 days out, what's an at the money? So I mean, even a repair trade, if I own the shares around 180, and even if price goes to a standard deviation move at 167, I get, for a 30-day call option, I get about $15 to $20. So yeah, I think that it's straightforward within maybe a 1 or 2 month window to repair it, try to generate it or flip it for maybe $500 to $1,000. And obviously, if I want to own it longer term, then I could, but that's usually not my style. I try to flip things. If I can make a 1 to 2% flip, then I try to do that. But anyway, I'm in the trade. So that's CrowdStrike. I've got it built. Let me get this one in for Project Options Edge. This is new trade. CrowdStrike 116 of 26 expiration. Buy the 200 put. Sell the 195 put. Sell the 190 put. $4.08 credit. This is a 111 strategy, and I'm willing to own 100 shares of CRWD if price is less than 190 by expiration. Break even for ownership is 180.92. Okay, so $4.08 credit if price is greater than 200 by expiration. We have a potential 908 max profit if price is greater than 190 and less than 195 by expiration. And assignment of 100 shares below 190. And there's ways to manage that. I talked about that in my Project Options Edge class. We talked about it last week. We'll revisit that today in class. You don't have to take the assignment. If you wanted to manage that sell put for a 2 to 3 times loss on that particular put itself, I mean you can get out of the trade with a small manageable loss, probably less than $1,000, versus taking on the shares and have to fork over anywhere between 10 grand margin or up to $19,000 in cash, which I'm not super excited about. But on my portfolio margin accounts, that buy power is going to be maybe like $6,000, which I'm okay with. So let me get that image in here. Where is it? Park that here. There it is. Okay. Trade is in. Are you holding crowd expiration? Yeah. So the plan would be this: if I'm in the trade for $4.08, then let's say that price stabilizes or goes up, probably around the May, June, July window. If I'm over like 50+% profit, I might just take it and not worry about it. So I'd like to say for this trade, if I'm at 50+% of the max credit, I'll take it. And sometimes even faster. I mean, usually if this is I'm out how many days for the January of 2026? That is out 294 days. So by like the 130, 140 days of this trade, that's getting into this part of the profit or the premium decay. So that's coming into this stage where we're starting to see that waterfall effect. So if I can hold this, let's say this is around 145 days, right? Well, by probably 200 days, we're starting to get like the dramatic waterfall where the premium decay is faster and faster and faster. So what I'm trying to get here is, rather than waiting all the way to expiration for this last little chunk, usually most of the profit is taken around here. So like half of the move or about 2/3 of the move, if I can get 50+% of the max credit, I'll just take it. And sometimes it even becomes higher than that. So I'll watch it. But anything 50 to 75% is good. If it happens sooner than holding to expiration, obviously I'd take the profit, move on. Okay. All right. And that put side, I just want to look at that put's trading for about $4.40. So I'll make a note here. note the 190 sell put filled for $4.40 credit. If not wanting assignment, you can close this for, I would say, like a 2 times loss. So if you take 4.08 times 2, that'd be 100% premium stop. I would double that again. So I would go 408 times 3. So 1224. So that's a 200% loss to protect buying power and avoid assignment. So that way you would be out. You take a loss on that one, you're out about $780, $790 would be your max loss. And the bear put spread could still offer some bonus profits. So there might be a way to mitigate that risk even more. You have a potential $500 profit out of what would cost you maybe $1. So you got like a $400 potential profit that could help alleviate some of that risk. So if you see the parameters on my screen here, max profits 908. Max loss would be if I take the assignment, the stock goes to 0, which obviously that's slim. Buying power is only $500, so that's not bad. But I like it. Let me take a look at FTNT. So FTNT trading at 96. This one had lows all the way back down to $50. This one may not be priced out the way that I want, but I'm going to try to find out. Let's go out to January, and I'm looking at something in the 50s. Only if the premiums are good enough would I consider this trade. It's probably crap, but let me see what this looks like. If I buy, sell, and sell, I mean, that's not awful. We're trading at a low delta. There's about a 93% chance of profit on this one. It's an income trade. Granted, it's not a lot of income. Would I be willing to own some shares here at $50, $52-ish, $51? $51. I mean, that's back down to the November 2023 low. That's back below the July-August move of 2024. That would be back down to like the bear market lows are very close to it. I mean, again, I have no idea if that's the right trade, if this thing is going to drop, 60+%. But if it doesn't, I make money. If this is a, level of support and this moving average here and higher lows is a level of support, then I don't really have to worry about the trade. So it's another potential income trade. Obviously, it's not $400, but it's a 93% chance of profit with making $100. It's just one of many income trades. Let me see if this looks any better. Same. So there's a big drop off there when I go below $50. So if I go 57.50 by 52 by 50, that's 123. Or what I might consider doing would be what would be my break even here. So if I own it at 52.50 minus 2.5 and minus 123, I'd own it at 48.77. 48.77. If I did this as ratio spread, I collected 20 cents more. Probability of profit stays about the same. And now I would have $55 minus 2.5. I own it at 52.50. So obviously I want the lower assignment price. And I'm willing to sacrifice the, 20 cents credit. So it gives me a higher probability of profit by 2%. And again, this might be a bid ask that's pretty wide. I might not get filled here for $1.20 or even close to it, but I'll find out. So max profit trap there. If I was willing to take on 200 shares, that'd be 100 shares at 55, 100 shares at 52.50. So 55 plus 52.50 would be 107 by 2. So 53.75 minus about $1.13 and minus about $1.25. I'd own it around $51 instead of $48. Yeah, I'm good with this. So that trade's not bad. On this ownership, it would be 55 assignment minus 2.50 minus 1.10, $51. Maybe a 112. So that's $2 right there. Maybe. All right, let me look at before I jump into that one. It's okay. I'll take a screenshot of this one. It's okay. I'm not going to take the trade live yet. Let me look at Palo Alto. Palo Alto. Look out to January. Let me check the technicals on this one. Trading at 172. This one, I mean, I'd be interested at like, $106 or $66. I mean, who knows? Where's the big support at for this level? Well, I would say the lows of 2024, this yearly moving average, or this previous resistance. So that's a pretty big range, but between like 140 and 100. Obviously, I would air for like the lowest one. So can I own this at $100 or less? Yeah, I'll take a look at mRNA for you. Let me see if I can I construct a trade where I could own this potentially at $100. So let's go Palo Alto, PNW, go out to the 2026 expiration. Could I own this around $100? And I think I can. I could probably do a 111, pull in $143, own this at $94 and change, which is okay for an income trade. What would be a covered call if I went out to repair it? Anywhere between $5 to $8 at the money. So it's doable for repair. Probability of profit on the January expiration is about a 93%, fairly high. Can I shift this lower and still have a good probability of profit? Not bad. So I get $5 on the trap. Somehow that's actually better. $1.40 versus $1.57. Interesting. $1.92. Less of a profit trap versus this one. I kind of like this one more. So I'm going to take this trade for $1.50 versus $1.92. 250, 95, very low delta. Probably the profit remains pretty darn high. Ivy rank is I'd say medium. It's certainly not high, but it's a decent trade. It's a low delta trade. If I get, as long as I can pull this in for like $1.80, I take it. $1.85, I take it. I kind of finesse the numbers a little bit, but let's see what this one looks like for some income. Palo Alto. And then for this one, as far as fundamentals, so I like the CrowdStrike still has a fair market value that's higher than current price. Palo Alto, I think, might be around current value. Profit margins, fair value 251. So yeah, I mean it's fair. That I take it. It's a bit on the expensive side. Priced at your earnings, price to sales, but it's just a trade. So let me see if I can get $1.90 for this. So $1.90. Not filling. So let's see what I can get this one filled at. $1.90 not filling. Let's try $1.85. I might have to finesse the numbers if I don't get filled at like $1.75. Nope. $1.75. Nope. All right. So I'm going to cancel that and go 105 by 100 by 97. This one hopefully is a little bit better offering, or even this one. 125. Yeah, I'm just pulling in less premium though. Slightly higher premium. All right, let's see if I get $1.30 for this one. I'll try $1.35. Not filled. $1.30 is the mid price. Not filled. Jeez, that just collapsed to $1.07. Let me try to get $1.25. Maybe this one just doesn't fill. Yeah. $1.20 final offer. Probably not going to get filled. Nope. All right, cancel. Well, never mind, Palo Alto. You're not doing it for me. All right, moving on. mRNA. I've got one trade on CrowdStrike. mRNA. $31. What are you trying to do with this? Trying to dollar cost average? Do you know your break-even point? Do you know your break-even point? This double up trade on SPY. Dang, man. I had a stupid webinar at 1 p.m. This was a really nice trade. Double up service. I did a 29 debit, close out at 50 cents. Right now, that is trading for 90 cents. That is a pretty nice return. If it was closed out for 90 cents, minus 29, that's a 61% win on 29. I mean, that's a 210% winner. Oof. That would be sweet. We're just kind of pinning right around that 55 or 555 level today, which was, starting to light up really nicely from this area. So right in here, saw the lit up level at 55. I was really just trying to take it down to it. So I'm not terribly upset with how I managed it because it did come down to it a lot of times with a butterfly spread. I went from 29 cents to 50 cents pretty quickly. And then it was over in here, it's around 60 cents, about 70 cents, 80 cents, now trading for 90 cents. And that's just because price is hanging right at this level. So, I mean, it really is a beautiful pin trade today with the butterfly spread that looks like that. And that pin price could be potentially up to like $1.70. But right now it's offering 90 cents, which is pretty good for a profit trip. All right. You have a break even at 45. All right. Let's take a look. How many shares are you in for? How many shares are you in for? Because if I look left on this chart, I mean, the lows here are back in like the teens, right? So are you willing to ride this thing down into the teens? Fundamentally, let's see where we're at. Revenue forecast to grow, volatile share price. Obviously, it's been just collapsing. 3.8 price to sales. Fair value, don't even have a discounted cash flow model on the fundamentals. 3.8 price to sales. I mean, if it's in the biotech space, that's a very difficult space to trade because it's just insanely volatile. You have 300 shares. Okay. So, well, I'll just treat it like it's my trade. Okay. If it's my trade and I've got a break even at 45, if I have a break even at 45, okay, let's go settings. If my break even's 45 and you have 300 shares, well, that means that I would say my near-term profit target, to be fair, would be like the easiest way to get out of this trade. I don't know how long you plan on holding this trade, but if I look at the technicals right now, I would say if price pops up to this level, at that low, I would dump this stock and I would get out. So that low is around $60, right? So that's a 62.50 low. If this level gets hit, I would get out of this trade. If I had the shares myself, I would put a chart alarm right there. I would dump the shares, anything over $60, and be happy. But from 300 shares at 45, I would just look at, okay, right now, if I put in another 100 at 31 and another 100, let's say at 20 and another 100 at the lows. So what would be that break even? If we have 300 shares at 45, and then we do another 300 shares in total. I'm just talking out loud with simple math here. If I do one at market, so 3109 for 100 shares, and then another one at 20 for 100 shares, and then the lows around 13.27, so probably put in like a $14. So $14, another 100 shares. So this would be the math. I would have 3109 plus 20 plus 14 divided by 3. That's a 21.69 break even plus the 45 divided by 2. So $33 would be my break even. It's an improvement. It's not great, but I still look at the potential stock as being able to rally. I mean, there's some decent structure in here, right? Like decent structure in here where whenever this thing, I mean, again, this is the big if, but if this finds support and we have a rally, then that would be my first real target, would be back into this cluster before the bull market happened. And then, of course, we came right back to it. We did pause right there, but then once we breached it, now it's just a waiting game of this accumulation. You know, that's probably the reality of the stock. Is it's going to sit here and go sideways until something allows it to rally again. So the trick to this is like it could be fine to work your way through it, but it could also be just dead capital that you're just dumping money into a stock that has no interest in going higher. So I would not want to like break the bank on holding in and fingers crossed that it goes back up to $60. But if you did cost, if I leveled back into 3109, which is market, $20 and $14, my break even would be $33 and I'd have 600 shares. So if it gets back to, $35, $40, or you keep looking at that level around $55 to $60, you can obviously flip that for a nice little chunk of profit. So, I mean, that would be my plan if it was my trade. It's not perfect, but if that's not breaking the bank on allocation, it's not too debt of capital. There's probably not a dividend to it. Nope, it's biotech, so there's nothing for it. So yeah, I mean you're hoping for price appreciation. Looking at Gamma, how do you prioritize SPY, SPX? It really depends. I mean, I get a lot better reading on SPY. So when I get an SPY reading, this one started to light up as we started to drop today. SPY was a much bigger level with a huge net strike at 555, and the SPX was. We called it this morning during daily profit play. I said, look, directionally, this market might come down to 56 or 5600 or 5550. And it has, like, it's just been bleeding all morning. This looks a little bit different than where we looked at it, but I said, look, this 5560 zone, 5565 zone, this is the JPM, the JP Morgan 2020 Delta put that the market is essentially hedging around. And this is a quarterly expiration. So we're sitting right at this coming into Monday's trading. And I find this really interesting because if we're hedging off this level, I do think this finds a way to go off of it come Monday. Just because there would be so much hedging to the downside. But I think this should offer a pretty solid level of support as we wrap up the quarter. So if the market can get off that low for Monday, that would be pretty encouraging. I just don't know, where that's going to be. But when I come to Monday's session, the first thing I'll be looking at for Monday's session and even Monday's close is what is the 20 delta out to the end of June. April, May, June is end of Q2. And I'll just ballpark that right now. If we go to the SPX, and go to the end of June. And again, this isn't accurate until end of day on Monday. But if I go out to the quarterly expiration for June, let me go to SPX here. June is June 30th, end of quarter. Right now, based on current price, the 20 delta on the put side would be put in probably by JP Morgan. I'm just going to wait for this option chain to update, but we're talking about a potential level that the markets may be interested in falling towards. Ballpark says probably around like 5,200. Maybe less. Let's see. I'm curious what the 5,200 is, if that's a 20 delta. Lower. Wow. Okay. So the 20, and we're going to have a higher IV going into Monday as well. We'll have a higher IV rank. We'll have a higher implied volatility. I've got a 20 delta. Good Lord. 51. So yeah, it could be around like 51.40 to 51.55. Yikes. That would be the larger hedge on the quarterly expiration for Q2. So that would be JP Morgan bracing for some downside. We might overshoot that and then just have tons of hedging below it. But that just opens traders' eyes. Look, the low we had was 5,500, right? If this is Q2 with potentially a massive bottom level with just like major option flows and major hedging levels around 51.40 to 51.50, I think that's something to put on the radar. So I'm just going to note that. So we get on Moderna. Reacting, you good on that? Okay, I think we're good. All right. Let me go to SPX. So 5150 or so. Let me put a chart alarm, or not a chart alarm, horizontal race. Let's go 51. I'll just put 40. Okay. So that would be potentially a JPM put level. But if we overshoot it, I mean, obviously look left on the chart. There's resistance here that could become support. This would be high, low. You know, I don't know if the Bulls are going to step up for any type of finish to Q1. They've certainly been beat up pretty badly. We had, at best, what? We had a week, like a 1 or 2 week correction. So the bottom was in on the 13th, and we had a top on Tuesday, which would have been the 25th. So we had 12 calendar days, about 2 trading weeks, and this market has quickly faded it right back down. So I mean, I do think that it gets a little scary around this level. This 5100 zone is right in line with a 5140 is right in line with about a 618 retracement. So if this is high, low, lower high, lower low, lower high, lower low, if we're just going to slide lower, there's potentially a fib extension there and a fib fulfillment. But like I'm telling you, like this might be an overshoot where this market possibly between that level and the previous all-time highs where we had the deleveraging happening in 2022 to this outer trendline support. That's a big zone, man. And this bear market could go from a correction to a deep correction to a bear market pretty swiftly if things don't get fixed a little bit faster. So I would say that level would be my next big area to be watching. So this is going in line with what I'm going to talk about tomorrow. I have a class tomorrow at 12 p.m. Eastern time. It's a webinar that I'm doing called Money Manager Hacks, and it is it's very cost effective. It's $197 for the first 250 members, and it is just trading through the month of April, talking through the markets, trying to navigate this Liberation Day tariff cycle, what's happening for Q2, and getting ready for any potential further downside. So, talking about different hedges, different ways to play it, cost-effective hedges that hopefully have anywhere between 300 to 500% returns, or even more so. I've got a couple, like right now, I've got about a 5. I mean, and again, I know it's not going to hit this profit target, but for 44 grand out of a $950 risk, that's a 4,600% return. So I don't need to make that. I probably won't make that. But if I turned $950 into, $5,000, $8,000, $10,000, that does help get rid of a lot of pain this market might be bringing if we have another nasty move. So just like, look, I'm not the type of trader that's going to come in here and say the sky is falling and it's a bear market, run for the hills. Like this market could still show a ridiculous amount of resiliency with this low and this low still holding, right? I mentioned this the last couple of weeks. Like if we had a high to low and this market flushes down and this becomes a bear trap, right? This market could rip off of that, become a bottoming pattern, and we come back up, right? And this support and this support and this support hold, and we're no better off. It's a bear trap. It's a little nasty for a couple of days, but the market might find a way to stabilize. However, I don't think that the Fed put is in, nor do I think that the Trump put is in here. I don't think this bottom is very safe. I think this was the first reality check to a Mag 7 rotation from, too many stocks and too much money chasing 10 stocks and too much concentration at the highs with these, large mega cap stocks. And that was what this was. This was a Mag 7 correction that was then accelerated by concerns with tariffs, the economy, and now the concern is that the consumer is now the next concern. And if the consumer rolls over and inflation stays sticky, then we have bigger concerns because consumer cutting back is going to impact earnings. Okay. Impacting earnings will be an earnings revision. And depending on the severity of that earnings revision, could be way worse than what this market's pricing in right now. You have to remember that this market is forward thinking. So if for some reason this market is like, oh my gosh, these earnings revisions are so overstated, they need to be way lower, and they're forecasted to cut by 10, 15, 20%, we can have a swift drop in the markets. And so, this little 4 to 6 week drop might feel like, man, I wish it would drop like that again. I mean, it wasn't easy. This was a nasty 4 to 6 week slide. But if we double that again, we're in some open space where I don't have a lot of support until we get to this April or this August 2024 low, and then we're talking April low. And at that point, I mean, what's going to be the guess? Are you trying to catch the falling knife? I'm certainly not, right? Like, I'm not trying to catch the falling knife. So I'm just going to keep watching. I mean, this market either works its way in an orderly fashion, maybe it does, maybe it doesn't. But if I mean, this is my biggest concern. This is macro stuff. But if Trump and company with this administration want to see, and this is like almost a forced trade, if they want to see this 10-year drop, okay, if they want to see this 10-year drop, it is probably going to have to come with a painful slide lower in the markets. Because the only way this thing dropped over the last 12 months has been the market falling. That's the only reason that this 10-year has fallen. Because this was the Fed cutting rates and the market reacting the opposite way, which is the first time in history that the yield market did the exact opposite of the Fed's monetary policy cycle. So that's not encouraging. So the Fed, like, oh, the Fed's got to cut more rates. That's probably a terrible decision because if the Fed cuts more rates and the market reacts this way again, let's say the Fed cuts rates and the market's like, well, we did this here. Now we're going to do it here. That would be even worse. So I think in order for this to fall, the correction in the 10-year was because the market fell. We had the Mag 7 correction, followed by tariffs, followed by that 10 to 13% slide in the S&P and the NASDAQ. So if we have another chunk lower, that's about the only way I see the 10-year dropping more. And that is not going to be fun. And how much lower does it fall? I don't know. But there is not a Fed backstop, in my opinion, at those recent lows. A 10% correction, I'm sorry to say it, is not where the Fed steps in. It never is. It never has been. It probably never will be. Even here, this is only a 10% correction. Fed didn't do anything. Okay. It was surprising that yes, they cut in September 50 basis points, but they did that because of the SOM rule that activated in, July. So maybe that had something to do with it. Maybe it did. But the last time we've seen like major backstops by the Fed would have been coming out of 2022's bear market. And the Fed kind of pivoted on CPI a little bit and the market liked it, sniffed it out. We had a 20+% correction, but that's a decent pullback, right? That's a correction. So I just don't think a 10% correction is a Fed backstop. I think it's 15. I think it's 20. I think it's maybe worse. So if you're asking for Fed to bail the markets out, it's probably coming at a pain trade of maybe 20 to 25%. So that is the scary stuff that's out there. That's about as scary as it gets, in my opinion. I'm still going to trade through it. I'm not running for the hills. I've got big asymmetric hedges lined up, which is why I'm doing that webinar on Saturday. And I'll be trading with everyone through the month of April to position for it. There's a variety of ways we can do it. They're pretty cost effective. I rarely take hedges that cost me more than like half of 1%. But if I'm right on some of those hedges, they can pay 2, 3, 5, 10% of my account could be paid for in hedges. So any type of pain that I would experience could be essentially washed. And that's what I'm trying to do is wash the drawdowns away by mitigating some of that risk and then be able to build back at a better price where I think there's way bigger upside ahead. Right? So that's a wild drop. How much that happens around Tuesday, at least next week. I mean, Monday is really the big line in the sand for me. Monday quarter, I want to see if the market can defend that 55-65 level. The markets today were pretty nasty to the downside. My daily profit play, this is the level we were watching for the morning. I decided to take a small loss today. It was manageable. I pulled in, 240 and I closed out for 770, I think. So I lost 530 on the day, which is okay considering the max loss was $10. So I saved myself a little bit of risk. That's worst case scenario. But I just didn't think that this market was going to come back up and try to get back above my line in the sand, which, I mean, we're 10 minutes away. There's obviously no way this thing's going to jump up 40 points. But coming into Monday, looking left in this chart for Monday, we have this gap that this market might be so close to filling that maybe Monday is going to be like a little slide, and then the market kind of catches back up and we get back above like 5,600 for a Monday close and quarter close. So, I mean, next week could be a pretty wild week. So I mean, I'll watch. I hope that we stay above 55.65. I'd like to see the XSP stay above 560 if possible. So I'm watching closely. XSP trading at 557. I need to see if we can get a $2 to $3 move above that for Monday. And let me check my expirations really quickly on XSP. I know I have a couple out there. I think 560. I'm not sure if it's a Monday expiration. Nope, they're out to April. So I've got April 4th, which is next week. April 4th next week. Um, April 11th, and then May. So I mean, I've got the week to kind of see if the Q1 or the Q1 end and the Q2 kickoff is going to get worse or it's going to get better. So there's certainly some risk on these trades that I need to be mindful of. But other than that, I mean, I will figure out how to trade through it and survive it. Hedges are probably my best friend right now, just in case, But if this is okay, this was a decent dump, and this gap could offer some type of support. Maybe this like slow drift to the downside gets picked up a little bit with a little bit of a rally. The way that it fell today was certainly pretty inefficient. So maybe the market pulls back into that zone at all, in some way, shape, or form. Who knows? But I wouldn't really get overly excited about the bull stepping back in until they're kind of satisfied with, okay, well, if they want to fight, where are they going to fight from? Probably from a good price. So if the bulls step in at all, maybe they step in here at the gap. Maybe they step in here with a gap fill. But buckle up for a pretty interesting week for next week. Q1 ends, Q2 kicks off. Trump's on April 2nd. We've got non-farm payroll on Friday. We're about to see if there's any scared investors with a jobs market that topples over into some like nasty non-farm payroll announcement. Then yeah, we could have what? Give me 1 second here. All right. Sorry. Text messages. So anyway, next week, do we have any fight in the bulls in this low? If they don't step up, then ladies and gentlemen, we're making some fresh lows, and this is probably going to get worse. It's like I don't know why the bulls can step in all of a sudden and say, "Hey, we got it from here." It's like, do you? I think that there's way worse things that haven't been priced in, and there's nothing about this chart that makes me like super optimistic. You know, so I mean, it could be like, the markets move fast. And so we have a high, low. I could see a bear trap for a second, and then the market comes back up and kind of chops around here. I could see that happening. But if it rolls over, like I think the scary part technically is below these lows, like what stops it? What stops it from here? Nothing. What stops it from here? Nothing. That low and that low. Why is that? Why is that support? It's not. Like this is major support all the way back here. So to me, this would be like a sell the rally environment. And I'd much rather be focused on being bearish, which I know is not always easy, but we'll find out next week. I mean, it's not that hard. Like I'll be living through it right alongside you. I'm just trying to be prepared for this potential floor breaking and getting a lot worse. Because if it doesn't, well, that's easy. If we come back down here, we find this gap and we head back up into, 5,600 or higher, fine. That's not a bad deal. We come back in, maybe it's this. This could be a bear flag, right? High, low, we have a bear flag, and then the market sells back off. Well, that's fine because we at least get a chance to right the ship a little bit and kind of de-risk again before maybe it lines up and gets worse. But if it's just straight to the downside, I mean, the bears either step in with a trap there where the bulls can pop it back up, or the bears just do too much damage, and then any type of retracement is just sell the rally. So it really is like critical stuff. All right. Won't early April depend somewhat on, I mean, probably early April to even all of April. I mean, if the market's thinking like, okay, how are we going to price this stuff in? April 2nd might be like how this market decides, hey, we're going to move forward on pricing something in. I don't know how Trump's language is going to be like soft and encouraging for the markets because we're still passing tariffs. We're still passing retaliation levels. We're still very much like a we're kind of administering isolation policies, right? It's like we're becoming more America first. And I get it. Like we've had um, disadvantaged trade deals for a while, and I get it. Like there's positives that come out of this, but it is not without potential pain. And the reference that I was making this week was going back into 1998, where we had basically a kitchen sink saved in the markets right before the second half of the year. This was, I got to go way back here, but this was leading into like this big rip into the 90s, and all of a sudden, 1998, this market decided by July it decided to drop 22%, and then end up finishing the year at all-time highs. That's insane. Like that type of whiplash in the market could be extremely frustrating to trade because you're just panicking, 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 and then the market's right back up where it started. And it's like, if I didn't do anything, I just kept all my money. But you're down 20+% on an index, which individual stocks are going to get beat up way worse than that, right? When I quantify the time frame, nope. I'm hedged out to August and I'm hedged out to December. Those are my time frames. Because if we're going to continue to see this short-term pain and it's going to be fast and furious, then if I'm hedged out to August, I've got plenty of time to catch, what might be a nasty April or May. What's interesting is like there is little to no seasonality to this market right now, because a typical seasonality move is this: January, February, March into April, April, May, June, July. That's usually what the market does from January. And then we get into August. We have a little dip in August, September, and then October to December. That over 75 years is roughly what the market does. S&P 500 since 1949, right? We have a little correction coming in February, March. We stabilize in mid-March, and then April, May, June, July, pre-summer push into the rally. And then we have an August, September pullback, a lot of tax loss harvesting for bad positions. October to December, Q4 is usually pretty positive. So if we're going to see this at all, I mean, we better see it. Because if all of a sudden this is like the forecast, right? This is like what the market's done over 75 years. But let's say the actual is, well, January we went a little bit up, and then February into March we were here, and now we're back down to the same lows. So is it going to be up for April, or is it going to be down for April? I do not know. But if it's going to get worse, then that's why I'm positioned out timeline wise to, maybe August, September, and December. Because if this wants to sell off to some of the levels I'm watching, well, there's a lot of profit that can be made there. And obviously a lot of additional premium that I can be selling and options I can trade and, kind of bargain shopping I can do. And I don't need it to get back to these all-time highs. I need it to basically just stop going down and then start building back in at a much cheaper spot. And then eventually, how long does it take to get back to the highs from this year? Because we did see all-time highs in February, So if we have a 20% correction, then a 25% move is what gets us back to all-time highs. If that on an index is going to give you some direction that's going to be pretty aggressive, I will be pretty bullish and pretty aggressive whenever I feel like the coast is clear to be that way. Okay. But not new government. Yeah, but it's not that different. It's not that different. The difference with a new government is that it's a little bit rougher through August and September. The rally from April, May, June, it usually peaks out in like July versus going all the way into August. That's about the only difference. I've got a tiny little screenshot of it. I didn't get the quality of it that I wanted to, but this is it. So if I can see if I can zoom in, there we go. So this is the new administration for the blue line is now, right? So we made fresh highs in February, and now we're dropping, and we're dropping. If you look at the post-elect year after the incumbent loses, that's the red line. That's the red line. So red line is February, March we drop. March we stabilize. March, April, May, June we have a rally, and then a little choppy summer, nasty August and September, and then we still pick up and kind of pick up the pieces, dust yourself off for Q4. So sure, it's not going to be easy, but if we're putting in all the pain now, I mean, I guess what we consider to win this year is if the market has a nasty move to the downside, but yet it comes back to all-time highs by the end of the year. That I think would be considered a win for the markets because no damage was done. Although you obviously take a 12-month window with no damage done, well, that doesn't tell the true story of how disruptive it is to watch the market drop 10, 15, 20% if that's what it does. So that's what makes trading the game that it is. It's not freaking easy, So I am planning for the best, preparing for the worst, taking what I think are high probability trades. Certainly not trading anything big right now. I'm scaling back on trade size. I'm keeping the risk pretty small and contained, and I think that's the best way to do it. To trade through this stuff. Okay. All right. It's officially closing bell. I got to wrap up today's session. If you're interested in joining me for a session on Saturday, here's my Telegram channel right here. So I'll post my weekly recap. I do have a webinar link coming. If you want to join my Telegram, I think most of you might be in it already. So there will be a link that posts for Saturday. It's going to be a 12 p.m. webinar. I'll share it in the link. I'll share the link right here. Let me go to, let me find it. It is prosperitypub.com/money manager hack. That's going to be my session for tomorrow at 12 noon Eastern time. So post that right here. This is Saturday, 12 p.m. Eastern time. Money manager hacks. That's a 12 p.m. Eastern time webinar you can register for. So I'll be live from like 12 to 1 Eastern time, and I'll start servicing this class every Thursday in the month of April. We will be doing core strategy class on the first week, and then we'll do live trading and live analysis and trading the next 3 sessions. So my goal is to be what I feel is properly hedged and fairly hedged out to kind of these seasonality pockets. So like hedge properly out into August, September, hedged out into the end of the year in case this market is going to make no real jump to the upside. And obviously, if I'm hedged out that far, but we have a decent decline in April and May, then yeah, I want to be taking profits ahead of time, and I'm gonna sacrifice some of the max profit, but I could still probably generate 2, 3, 4, 500% returns on some of those hedges. So it is a slippery slope. It's gonna be a thread the needle scenario between the Trump administration and the Fed. When I think if one's going to put pressure on the other, it's going to be the Trump administration is going to put a lot more pressure on the Fed. And to do that, they're essentially going to be, pedal to the metal, trying to get this market to drop, trying to get inflation lower, trying to get some of the key metrics like the 10-year yield lower, trying to pass a major tax bill, which to do that, you need to see lower borrowing costs. It is potentially going to come with a lot more pain. And I know that also, like as a contrarian, it's like, well, sentiment is super bearish. And what was bearish sentiment this week? It probably changed a little bit, but AAII this week. So it retreated a little bit, but it's still a 35% differential. Historical averages, 31% bearish to 37%. I mean, it's obviously way more bearish in the last month than it has been in a long time. So it's faded a little bit, but after this week and this drop and this close on Friday, like where are we going into next week? I don't know. But the market sentiment is not turned positive yet. I will check one more thing before I go. I've got to jump into another class right here. Let me go into the how many stocks above the 50-day moving average. Okay, this is kind of my market breadth indicator. We still have about 40% of the S&P stocks above their 50-day. As a market timing indicator, if we flush lower, then I'm looking for a buy opportunity. Okay, and that buy opportunity that's not long term. That is a short term buying opportunity, because you can go back here into 2022 and see that there were buying opportunities. COVID was obviously like a great buying opportunity, but then 2022, you had one opportunity here back in June. The market still made lower lows. One opportunity back here in September, the market was making the low. So that's a pretty good spot there as far as like, yeah, you weren't too far off from finding the market's low. You go into the NASDAQ. NASDAQ is still about 36% of stocks above the 50-day moving average. Same thing here for January 2022. When the market was deleveraging in a big way, you still had some timing indicators to buy, but the bottom was back in September, not May and not in January. So you had a chance to, buy low, but it was a short-term rally that was short-lived. Market made, fresh lows, fresh lows, fresh lows, fresh lows, and you had this timing indicator that said, well, in May, in September, you had a good chance to buy. Well, May was good for a retracement, but it was flushed again and flushed again. So this is at least something I'm watching for a bigger picture move. But I don't think market breadth bottoms are in. I don't think the Trump or Fed put is in. I think this market needs to show, like, it's got to show some resiliency, or else there's not really a lot that's going to stop this decline. So, and I hate to be pessimistic, because I've traded through it. I'm going to trade through it. I've made a lot of profits these last couple of weeks, but this is literally going around with exactly what I said for the last month. This market fell. If this market gives you a chance to de-risk, you better take it. And that's exactly what we've seen, right? This market had dropped to the point of extremes where we had oversold conditions with nasty sentiment, but it also offered a 2-week pullback. That 2-week pullback, get the hell out of those trades that are looking really bad. I did. I still have some risk. It's not going to be pretty. It's going to be a battle, but I am prepared a lot better for whatever comes next, because if it gets worse, I've got more hedges, I've got more cash at the ready, and I'll trade it. If it gets better, well, then that's kind of easy. And this might be some weird slow grind, and maybe it's this, and nobody makes any direction. But I'd still be concerned that this rolls over at some point. So it really just depends on how fast this market's going to flush. It could be an ugly first part of the year before we pick up the second half of the year and improve, or it could be like, bad Q1 and then just a rough summer, and then we have either a decision one way or the other by the end of the year. And the sad part is my outlook is either direction can happen, and that never feels good. So plan for the best, prepare for the worst. That's it. That's all you can do. All right, buddy, I'll let you go. Have a great weekend. I hope to see you all on Saturday, 12 p.m. Eastern time. That is prosperitybub.com/money manager hack. You got the link in the chat. It's in my Telegram. So I'll see you then. All right, thanks. Project Options Edge Traders. I'm going to jump in the session right now, and we'll see you in the next few minutes. All right, thanks. Bye.